Options traders typically put on positions with 30 to 60 days to expiration, meaning that their stock price outlook or prediction is usually falling within a 1 to 2 month time frame. But in this video, we're going to talk about LEAPS, which are longer term options, and more specifically, we're going to talk about the differences between trading short term options and longer term options, or LEAPS, and some of the things that you need to be aware of when trading LEAPS. I'm also going to show you how LEAPS can magnify your stock price returns by comparing a LEAP option or long-term options percentage gain relative to the same movement in the stock price. First and foremost, what are LEAPS? LEAPS are long-term equity anticipation securities, or LEAPS for short. To me, LEAPS are options with more than a year to expiration, meaning they have 365 days or longer until they expire. But if you look around on the internet, you might find some different time frame definitions. But at the end of the day, a LEAP option is an option with a lot of time until expiration. If we take a quick look at the available expiration cycles for SPY, which is the S&P 500 ETF, you'll notice that there are a ton of different expiration cycles that we can choose from, ranging from 0 days to expiration, meaning these options are expiring today, all the way out to December 2022, which is about 960 days out, or 2.5 years until these options expire. So these longer term options, specifically with a year or more until expiration, are called LEAPS, or long-term equity anticipation securities. They're called LEAPS because, as the name suggests, if a trader puts on a position in an expiration cycle with 2 years to go, they are putting on a trade with a 2-year time frame for whatever stock price prediction they may have. Let's hop over to the Tastyworks trading platform so we can discuss LEAPS in real time and look at some real options that are currently trading. And so I can show you the differences between short-term options and long-term or LEAP options. And then we can look at an example of how these options perform relative to changes in the stock price. All right, let's go ahead and take a look at some LEAP options on SPY, which is the S&P 500 ETF. So as I mentioned earlier, LEAP options are typically defined as options with more than a year to expiration. At least that's how I think of them. But honestly, you could think of these longer term expirations such as November and December 2020. You could consider these LEAPs too, since they are 6 to 7 months out. But typically, if I'm going to make a LEAP option trade, I'm going to be at least a year out, and in most cases 2 years out, or sometimes I'll just trade in the most long-term expiration cycle that I can, such as the December 2022 expiration here, which has 953 days to go, which is about 2.5 years out. So these are super long-term trades, and the reason you would want to trade LEAP options, as we'll discuss shortly, is that you can amplify your gains relative to the movement in the stock price. So by purchasing a LEAP call option, for example, if SPY goes up 10%, the LEAP call option that I buy is going to experience a far greater return than 10%. And we'll look at some examples of that in just a moment, and I'll show you how you can actually put the option price on the chart so that you can see the price changes of the LEAPs. But let's go ahead and compare a few things here. The first thing I want to compare is liquidity. So if we go to the May 2020 expiration cycle with 8 days to go, this is considered the front month expiration cycle, meaning it's the standard monthly expiration cycle, and it's the most near-term standard monthly expiration cycle. So since we're in May, that's going to be May, but once these expire, the front month will be June, and so on. So the first thing I want to point out is that the open interest is in the tens of thousands for basically all of these strike prices. So that means there's tens of thousands of open option contracts between two parties at all these different strike prices, and that means that there is a ton of trading activity in this particular expiration cycle. We can also see that the bid-ask spreads are very, very wide, or very narrow, and that is a result of all the trading activity that's taking place. So if I look at the 290 call, the bid is 352, the ask is 355, so 2 to 3 cents wide there. So if we go out to January 2022, the first thing you'll notice is that the open interest at a lot of these strike prices is somewhat thin. So we have some strikes with hundreds of open interest, some in the thousands, and this is still decent in my opinion for a 2-year call option or 2-year option, so to speak. These options have so much time to expiration that people are not actively trading these. People are mostly entering these for long-term holds since they do have 600 days to expiration. So because of the decreased trading activity in these options, we can see that the bid-ask spreads are wider. So for example, if we look at the 300 call option, the bid is 27.43, the ask is 27.84. So we're seeing a bid-ask spread that's over 40 cents here. And when we looked at the call option in the May 2020 expiration cycle, we saw that the bid-ask spread was 3 cents. So the first big difference when you're trading LEAPS is that you will have less liquidity, meaning there will be less open interest, meaning that there are fewer open contracts between two parties, and the volume will also be lower. So if I go to volume, you can see that the volume is really low, and that's because people are not actively trading these. People are just entering these positions and holding it for the long term, as they do have over 600 days to expiration. So if I quickly go to May 2020, we can see that the volume here is in the thousands, so no surprise there. So going back to January 2022, what I want to compare now is the prices. So if we look at the 300 call option, we can see that this price is $27.50 or so. And if I click on the ask price, which basically sets up in order to buy this option, we can see that this option is actually worth about $2,800. That's because we have to take the quoted price of about $27.50, multiply it by 100, which is the option contract multiplier, and we get the option value of $2,800. If we look at the 300 call in the May cycle, the 300 call is worth 40 cents, so that's $40. So obviously there's a huge price difference here, and that's because with 600 days to go, there is a much larger expected range for the S&P 500 over a 2-year period, and that's why these options are significantly more expensive. But this brings me to my next point. Even though they're more expensive, it doesn't necessarily mean it's a bad thing, because the longer term options are actually going to have less decay. So if I click again on the 300 call option, more specifically clicking on the ask to set up a buy order, we can see that the theta is negative 2.6. So this means with each passing day, assuming no change in implied volatility and no change in the stock price, I would lose about $2.60 per day if I bought this call option. So losing $2 a day on a $2,800 option is not a big deal at all. And as we can see, the delta is 50, and that means if the stock price or SPY goes up $1, this is expected to gain $50 in value. So basically, if SPY went up $1 in a day, the cost of time decay would be negative $2.6, but I would effectively make $50 from the directional change, and therefore I would still come out ahead. So the big difference here is the decay. If I go back to May and I look at the money option, which is the 290, it's trading for 350, but the theta is negative 23. So this option is far less expensive, but it has way more decay, and that's because it expires in 8 days. Now the reason I wanted to make this video is because I think LEAP call options, particularly on stocks or products that you are bullish in, is a phenomenal long-term strategy. Particularly if you are bullish on a stock over the next year, you can use LEAP calls to gain immense upside exposure. So I'm going to right click on this. If you right click on either of the prices on Tastyworks, it'll say view option and chart. So I'm going to do that on the 300 call, and we're going to view the option price in the chart. So as we can see here, this basically looks like a chart of SPY, and that's because this is a call option, which is a positive delta position, and this is going to track the changes in SPY very closely. So as we can see, we had the big rally up until February 2020, then we had a massive collapse, and now we're rallying back up. So if we look at the actual change in the option price, and remember this is the 300 call option in January 2022, which is about 2 years out, we can see that at the bottom of this market move, this call option was worth $4.20, if we can look on the right-hand side of the chart. So the bottom was $4.27, and currently with the market rally, this option is back up to $28. So if we do that math really quickly, 432 to about 28, I'll just do the current option price is $28. At the bottom it was $4. If I do minus 1, that's a 600% gain. So from the market bottom in March to the current market level, This 300 call option with 2 years to go experienced a 600% price increase. Let's compare that with the actual price increase in SPY. So if I just go to SPY, the bottom was 218 and currently it is at 287. So if I do 287 divided by 218 minus 1, we get a 32% increase. So the 300 call option expiring in 2 years increased 600% from the market bottom to the current level. But SPY itself increased 32%. The 300 call option expiring in 2 years experienced 20 times the price increase compared to SPY. SPY went up 32%. So basically, if you were lucky and you bought shares of SPY at the bottom and you held until now, you are up 32% on your investment. But if you had bought the LEAP call option, particularly the 300 strike expiring in 2 years, and you bought that at the market bottom and held it until now, you are up 600% on your investment. So I'm not necessarily saying that you would have bought right at the bottom and held until now. I am merely comparing the two price movements so that we can understand how a LEAP call option will change relative to the change in the stock price itself. So as I said before, by purchasing a LEAP call option, you can get immensely leveraged upside potential compared to changes in the stock price. And that's because, as we saw here, SPY went up 32%, but the LEAP call option expiring in 2 years with the strike price of 300 went up 600%. In terms of trade management, I would not recommend actually holding until expiration because, as we saw here, if you bought those calls with the 300 strike and you rode them up until now, I would actually probably take a portion of those positions off to lock in a bunch of gains, but then you could hold a portion of those and let them ride out for another year or so. I hope that discussion was helpful for you and now you have a better understanding of what LEAPS are. As we discussed in the video, it's important to keep an eye on the liquidity or the open interest and volume of the LEAPS, but more importantly, the open interest is what you're going to want to look out for. Not all stocks are going to have good LEAP markets or long-term options because in a lot of stocks, you're going to find that if you look at a 2-year call option, for example, the open interest is going to be close to zero and there will be no volume in there. And as a result, I wouldn't recommend trading long-term options in stocks such as those, but in something that is incredibly active and popular, such as the S&P 500 ETF or popular stocks such as Apple or Google, I think you can safely trade LEAPS as long as you pay attention to your fill prices and try to get filled at the mid price or lower. As I mentioned when we were on Tastyworks, I'm not recommending that buying LEAP call options or long-term call options is an easy trade by any means. There's still a lot of risk, but the benefit of buying long-term call options is that if you are right and the stock price does increase, you are going to have a significant percentage return on the money that you've allocated to that call option position compared to the same movement in the stock price. You might be wondering why I didn't really talk about implied volatility when talking about purchasing long-term call options. And the reason for that is that typically long-term expiration cycles that have 2 years out until expiration, those implied volatilities are going to be very stable, and typically those are going to trade with higher levels of implied volatility than the near-term cycle. And that's typically when we're talking about a lower volatility environment. So if we had a 15 VIX, the near-term SPY option cycles would be trading with implied volatilities around 15%, and it would be typical to see the longer-term expiration cycles trading with implied volatility over 20% in that scenario. But at the end of the day, it is still a risk. You do have volatility risk, meaning that if you bought options in a super far out expiration cycle and implied volatility comes down a few percentage points, you are going to experience some losses on those options, assuming that there's no change in the stock price. But typically, if we saw a few percentage points decrease in the implied volatility, then that means that the stock price is typically rising and volatility in the market is coming down as a whole. So in theory, you should probably still see some profits if you saw the stock price go up 10 or 20% and implied volatility came down a few percentage points. But the most important thing is that in those long-term expiration cycles, the implied volatilities will be very stable and you should not expect them to fluctuate around a lot. If you do decide to go out and invest in some long-term call options with 2 years to expiration, just keep in mind that you are still buying options, and if the stock price stays below that call's strike price over time, you are going to lose money on that investment. So only invest an amount that you would be comfortable losing 50% of or 100% of. But since you have 2 years to go, and especially if you are investing in SPY call options, which is a very safe product to be bullish on long term, then I think you'll be fine. As always, thank you so much for watching. My name is Chris from Project Option, and I hope you learned something from this video. I'll see you next time.